Good morning, everybody. It's Ed Yardeni. We're going to have a guest on in a minute here. But before we do, I just wanted to go over some of the points we've been making in the quick takes and morning briefing. I'm happy to say that Max is here. Max has been a no-show for a while, but he decided to take a little snooze here during our discussion. Today is Monday, May 11th, 11 a.m. Eastern Standard Time. And in thinking about the markets, there's obviously a load of stuff happening this week, including, I think, what could be an important summit between President Trump and President Xi of China. Then we also have CPI and PPI. I think everybody knows that they're going to get boosted by the energy shock. Um, Looking backwards, we had obviously some important data on employment. The employment numbers were consistent with our hunch that the data would be better than expected, simply because a lot of the labor market indicators have been looking better and better over the past few weeks. There were some concerns, obviously, wage inflation moderated, which is not a concern if you're looking at, let me see something here, which is not a concern if you are thinking about inflation. And I think that's an important story because when we compare the current environment to what we had in 2022, the first thing we had was the supply chain disruptions, which were very inflationary. And the supply chain disruptions really started as soon as the lockdowns ended in 2000. We had lockdowns for a couple of months, and people went on a buying binge, particularly for goods, because they couldn't buy services. And meanwhile, the pandemic disrupted global supply chain. So we had a kind of a mounting inflation problem that became increasingly obvious in late 2022. And exacerbating that was Russia invading Ukraine in early 2022, which created a lot of upward pressure on food and energy prices. So that combined with the upward pressure on wage inflation because of the disruptions that we had in the labor markets. We had a lot more demand for labor than we had supply there for a while. And so we had a wage price spiral. It didn't last very long. It was a couple of years, but it certainly was an embarrassment to the Fed in terms of them recognizing that there was a more persistent inflation problem because this was more of a wage price spiral. This time around, there's no sign yet of the wage inflation and a wage price spiral. We are going to see higher prices on energy, and that will have some impact in areas that where costs are going up, like airfares and all that. But the other thing to recognize on the positive side is the reason wage inflation is slowing down to a certain extent can be interpreted as a result of the retiring baby boomers. We've made this point many, many times, and we want to put it in the context of wage inflation. Wages are actually falling in real terms now for the past few months because of the energy shock. So March, April, May, we're going to see that real wages are down. And the reason for that is partly because retiring baby boomers, they're included in average hourly earnings, and the inflation rate there has come down, which means that as they are retiring, their high wages are dropping out of that average. And the average hourly earnings measure is very sensitive to composition. And in other words, remember when we had the pandemic, we saw that there was a lot of low-wage workers dropped out of the labor market because they worked at restaurants and things like that. And that led to a spike up in average hourly earnings. So it can be a very misleading indicator when there's big compositional shocks in low-wage versus high-wage workers. And I think that's kind of what's going on here. Why is that good news? Well, it's good news because it's not bad news. In other words, yes, wage inflation is coming down, but it's not as much of a weight on consumers' purchasing power as you would think, because the baby boomers, while they may no longer have their high wages, they have a substantial retirement income and, of course, assets that they will increasingly be spending. So we're not particularly worried about the purchasing power story. Of course, that relates to our earned income proxy, because our income proxy is a proxy for wages and salaries in personal income. And that proxy has been weighed down by wages and also by the relatively flat employment statistics. Employment is getting better, but still, it's not the old 150 to 200,000. And again, that's probably related to the baby boomers retiring. And so a lot of what's going on in the labor market is employers have to decide, well, if they're losing baby boom employees, how are they going to replace them? Well, they'll replace them by maybe promoting some people who had been working in middle kind of in other jobs, and at the same time that'll create job openings. So we think that's what's going on in the job market, and we don't think that AI net is a job killer. We think net it's going to increase jobs. The participation rate went down, and again, that's obviously related to the baby boomers. The baby boomers are retiring now. They're in their 60s, 70s, and as they retire, that means that the participation rate is going down because it's the number of people employed over the population. It's the labor force over the population. Oh, there's a not right now. Oh, I've got Bailey here. She's whining because she needs some attention. So we'll see how long I can ignore her. But at any rate, so the whole labor market story is a pretty good one. The other thing I want to mention before I get my guest on in 2 minutes, I guess you've seen the quick takes that Elias, Toby, and I put out on our new thoughts about the outlook for the stock market. Obviously, Joe's involved in that process of discussion of what we want to do. And what we did is we raised the outlook for the stock market. Maybe you got to be careful here because that could be a contrary indicator. But when people like me get who have been bullish turn even more bullish. But I really couldn't help myself. I've been bullish, but not bullish enough. At least not compared to what analysts have been saying. And the analysts have been wildly bullish, which is interesting because they've been raising their earnings numbers. We were using $310 a share for this year for S&P 500, and now we're taking that up to $330 a share for next year. We were using 350, and we're taking it up to $375. And both of our new estimates are actually slightly below where the analysts are. So the analysts are, I can't get as exuberant as them because I'm concerned that maybe they're getting too exuberant. But I don't think this is going to be like 1999, 2000 all over again. That was a PE-led bull market. And this one is an earnings-led bull market. Let's call it what it is. It's a melt-up. It's a melt-up, but it's an earnings-led melt-up, and the earnings expectations are rising because the companies are delivering better and better earnings. So Put all that together, and instead of 7,700, we're using 8,250. Now, in order to make sure that I don't go too far on the bullish side here, it's important to acknowledge, as we all know, the wars isn't over. There may be some sort of haphazard ceasefire going on. Right now, there's negotiations. One, each side is putting a list of their demands on one sheet of paper. Kind of a bizarre way to negotiate, but that's the way it's being done. And clearly things could flare up again. And meanwhile, the Strait is still closed, and that is creating supply problems, not just for energy, but for other commodities. So, Bridget, you want to press the video button so we can see you? That's great. Bridget, how are you?
I'm good. How are you?
Good, good. I'm glad we got you on. Bridget DeCosimo is with my good friends over at Capital Alpha. We've had Jim Lucier on before talking about tariffs. Bridget, you just joined Capital Alpha recently. How long ago?
Yes, I joined in February,
In February.
mid-February.
Okay. And where had you been before?
I was with Energy Intelligence
Hmm.
for about roughly 10 years, and before that I was with a very nerdy trade publication called Inside EPA, writing
Oh,
about everything from chemical policy to the Clean Air Act.
so at your previous position, what did you write about? What were you analyzing?
At Energy Intelligence, I was on the editorial side, but I did a lot of analytical type writing on pretty much everything affecting domestic and a bit foreign U.S. energy policy.
Hmm.
So all
Well,
things oil and gas,
well, well,
etc.
maybe bring me back down to the planet Earth. I may be too bullish here, and if I am, it's because there's a sort of a ticking time bomb here in this Strait problem. That the longer it lasts, even if the war doesn't heat up again militarily, just having the U.S. blockade Iran and Iran blockade the Strait. There's a lot of commodities that go through there, and you wrote a very good piece, I thought, on that it's not just all about oil. There's other commodities, but uh, uh, it's still also to a large extent about oil. So I guess in terms of sectors and commodities, which ones that are most heavily impacted, do you think, from this? And when do the rest of us start to recognize it, and which then would be recognized by the stock market?
Well, I think nearly every sector is seeing some kind of supply chain knock-on impact at this point. You have roughly 200 petrochemical facilities in the Gulf. UAE, Saudi Arabia, and Qatar are all significant producers. And this is a case where we've gone from something of a surplus to a something to a scarcity very quickly. So the aftershocks are going to be pretty widespread, we think. We're talking about commodities that are feedstocks across numerous industrial supply chains. So things like agricultural chemicals, 20% of seaborne fertilizers pass through the Strait. For specific fertilizer chemicals like urea and ammonia, those percentages are actually higher. The Food and Agriculture Organization has been sounding the alarm for weeks now on the possibility of lower crop yields and food inflation, which is going to have market impacts. And some countries could end up enacting domestic policies to inoculate against price shocks for consumers, which of course impacts inflation. We've already seen China in March ban exports of certain categories of fertilizer. The FAO Director General warned of potential impacts on key
Right.
planting windows next month, resulting in lower crop yields for the fall. And a lot of these energy byproducts that come out of the Gulf are essential to plastics production. There was a recent Congressional Research Service report that noted that Charleston, South Carolina, is especially reliant on imports of paraxylene for plastics manufacturing, for example. About half of its waterborne imports are from Saudi Arabia.
Let me ask you, I
Oh,
mean, clearly, if investors are going to pay attention to this. If this somehow impacts the AI trade, that would obviously get everybody's attention very very quickly. I know you've looked at some of the consequences of what's going on for data centers. Can you sort of address that and also, I guess the whole issue with semiconductors? There's got to be a lot of containers of helium and party supply stores. So, is that going to be enough to keep this thing going, or do we have a critical problem here?
Yes, give me 1 second. Let me just shut off my alarm.
Okay, sure.
And sorry.
No problem. I have these technical difficulties all the time during our shows.
Apologies for that.
No, no problem.
So yes,
This is reality TV.
uh, so yes, data center build out is one of the things that there's been a lot of focus on with some of these supply shocks of late. We think it could mean pretty significant delays for data center construction timelines. There was a Moody's report earlier this month highlighting some of the disruptions to helium supply and how that's affecting semiconductor manufacturing. This is ultimately going to have implications not just for data center supply chains, but AI supply chains in general. The Hormuz bottlenecks have also had disproportionate impacts on South Korea and Taiwan, both of which are big hubs for semiconductor development. Qatar is responsible for roughly 34%, I think, of world helium supplies. There were two trains damaged at Ras Laffan. I've seen mixed reports on the degree to which those repairs will impede the facility's helium production, but it's definitely going to factor into how quickly we see the helium supply ramp up there.
Hmm.
The helium supply shocks in 2022 after Ukraine lasted roughly 18 months. You have roughly 1,500 data centers in various stages of development just in the US nationwide this year, according to Pew data. Aluminum has been another commodity that we're keeping an eye on that we've seen heavily affecting data center and AI build out. We've seen a global tightening of the aluminum supply. That's another one where it could be at least a year for some of these supply shocks to begin to rebalance. Data center construction uses a massive amount of aluminum, of course.
Hmm. And so, is helium like one of the major issues in terms of the AI trade in semiconductors? Doesn't the U.S. produce helium, or are there alternative sources?
The US does produce helium. Helium is a natural gas byproduct. Obviously, the US produces a good amount of natural gas. Uh, that is something that because it's used in so many sectors, the shortages have been impacting a lot of different supply chains. It's also heavily used in the medical industry as in MRI imaging.
Hmm.
Uh, the US is an interesting one because the US at one point had its own helium reserve, and I believe in 21 or 22 ended up selling it to a private buyer. So that we're starting to see more calls now for the US to bring back its own helium stockpile.
Well, one of the things I've observed over the years is that the best cure for commodity shortages is the immediate thing that happens in commodity markets is their prices move very quickly, reflecting supply and demand. So if you have a shortage, you'll get a price spike occurring, and then that price spike destroys some demand, and it also stimulates some supply. And I'm just wondering, looking at the price of oil, if you just kind of knew the facts on the ground of what's been going on and nothing else, and you just kind of just got informed about the whole thing, kind of a Rip Van Winkle situation. And you say, well, the price of oil's it's got to be like what, 175, 200, but it's still only 100. Is that because we're running down inventories? Is that because the White House is basically maybe when Trump called Putin, he said, you know what, don't worry about those sanctions on oil. If you want to sell oil to China and India, just be my guest. I'm not going to slap tariffs on them or anything like that. So in other words, is it possible that enough oil is leaking out of the Middle East one way or the other, and that Russia's kind of filling in and Venezuela's pumping more? And oh, by the way, the U.S. is exporting more. At least we have one week's worth of data suggesting that lo and behold, we're even a bigger exporter than we thought. So is it possible that the markets themselves are telling us worry, but don't worry too much? They're not saying worry, don't worry, be happy at $100. But could it be that I guess what I'm saying is if it turns out that the new status quo is in fact this blockade of Iran and blockade of the Strait, is it possible that the price of oil stays at 100, or within a few weeks or a few months, we're just going to be just totally bone dry when it comes to strategic reserves and backups and all that, and suddenly we get up to 175, 200, and who knows how much higher?
Well, I think all of the things that you mentioned have certainly had an impact in keeping prices from spiraling into the 175 territory. Prices dropped, what, 6% last week, just on the news of the negotiations. They're back up this morning, of course. But I think for one thing, we were starting from a pretty oversupplied market. And for another thing, we were starting with some pretty robust reserves globally. And
That's a good
uh,
point. Yeah.
I think those have now taken a hit. And
Mhm.
so I do think that we'll see more significant impacts if this stretches
Mhm.
into weeks and months, and we may see more dramatic shifts with each Trump social or Trump Truth Social post reflecting the state of negotiations. Like
Mhm.
we may see, I guess what I'm trying to say is we may see more volatility around the negotiations if this continues to stretch into weeks or months.
So let's say Trump and Xi get together and come up with some sort of amazing bargain where China does get the Strait open in a without any more military activity necessary to do that. How long does it take for these supply disruptions to dissipate? Will we still get hit by them? And there's still kind of a trough that we're going to hit in terms of shortages, and then things start to improve. I mean, how long is the ripple? You use the word ripple effect, and I'd use shock effects, whatever. What's your assessment?
I like ripple effects. So on the timeline, for one thing, just reconfiguring some of the traffic flows in the strait is something that could potentially take several months, whether you're talking about these commodity minerals and chemicals or whether you're talking about oil. Then there's the combination of infrastructure damage, reduced output from storage capacity being constrained. Both of those things are going to factor into the timeline. Carlisle's Jeff Curry has emphasized that even if the standoff gets resolved, even if it were to get resolved tomorrow, it would take over 3 months for supply flows to start to normalize. Exxon's CEO Darren Woods says 1 to 3 months with repositioning of tankers, supply backlogs, delivery to final destinations. And then you have things like tanker schedules, route shifts, insurance negotiations. Those are all going to have to be ironed out. I've seen some reports indicating that the Ras Laffan restart in Qatar of the two trains that will be offline could take more toward the 5 year side of the 3 to 5 year estimate that we've all heard. So when you think about that, a lot of the commodities, the fact that a lot of the commodities that we're talking about are oil and gas byproducts, that's going to add time to the equation as far as some of the rare earths and critical minerals that we're
Mhm.
talking about. Uh,
Yeah, I think the offset would be the likelihood that other potential sources are being ramped up already, whether it be the U.S. or Venezuela or Russia suddenly uh, is able to sell to more countries without issues?
I think those, yes, I think incremental production in Russia and Venezuela will certainly help. I think that the sanctions maneuvers with Russia and the ones with Iran will move the needle, but maybe not as significantly as the
Hmm.
administration was hoping.
Anything I didn't ask you that you want to kind of put on the table here, and then we'll look see if we got some questions from our audience.
Sure. The only thing that I would w wanted to mention is on the timeline for I talked about the timeline for oil a good bit. On the timeline for bringing back some of the higher levels of production for some of the commodity minerals. Some of the projections that I've seen that I think may be more realistic are along the lines of 12 to 18 months because there are a lot of implications of trying to restart these plants. I mean, it's not like you flip a switch. There's a lot of safety issues that have to go into it. There's a lot of logistics issues, labor issues, etc. So I think that's going to take a while to get sorted out before production really starts to ramp up again.
Bridget, I'm going to just thank you for joining me. I'm looking through the Q&A and it looks like people got a good feel for your views and some of the concerns that I've had that offset my bullishness. But if you just turn off your video and just stay tuned if you like, just in case I get another question for you. But meanwhile, I'm going to run in the next few minutes through a couple of questions that I've gotten on my end. But again, thank you. You've joined a great firm, Capital Alpha, been good friends of ours for many years. From when I was on Wall Street, they do great work, and you're a fantastic addition to their team. So congratulations.
Thank you very much, and thanks for having me.
Yeah, my pleasure. Thank you. Give my best to Jim.
Will do.
Okay. So with that, let me see what we got going here. Okay. Hey Ed, hi Ed, can you give some perspective on how the new Fed chairs gets tested early in their terms? I don't know that there's any regularity to it. Some people say that, new Fed chairs always get tested, but old Fed chairs also get tested. I mean, there's always something to test the Fed. I think part of the problem is that the Fed has kind of gotten gotten used to telling us that with monetary policy they can almost fix all of our problems. I think it would be kind of refreshing if the Fed announced one day that there's only so much they can do with monetary policy. But I don't know. I think Warsh is certainly going to notion that interest rates have to be brought down. That's going to be tested, and how he finagles that. Is he going to want to be in a minority voting for rate cuts when everybody else says not only do we not want rate cuts, but we don't even want to suggest that rate cuts are coming. So I think he'll be tested pretty quickly. Quickly, yeah. Willem, that was Bailey that walked in on us. Okay, Ed, great hearing that you think AI will increase, not decrease jobs. What is your reasoning behind that? Well, the idea there is we've had technological innovations before that were viewed as possibly destroying jobs, and often they did destroy jobs, but then they created new jobs that nobody ever anticipated. I mean, an easy one right now is instead of coders, we need prompters. We need people who can, I mean, I guess I could sit down and write 3 pages of prompts to get Claude to program something for me, but Melissa, who works for us out of Atlanta, has, I think I told you, I want to rename her Claudette because she's become a real super duper expert on prompting Claude and kind of tweaking Claude. So she's clearly a more valuable employee because of her ability to do that. Software programmers are supposed to be losing jobs, but if you look at Indeed's job postings for software programmers, they've actually been increasing rather substantially over the past year. Let me just turn that off. Um, so, uh, so we'll see how that all plays out. But there's this thesis that if AI reduces the costs of processing data, using data as another factor of production to increase productivity, that's just going to mean that we're going to be processing even more data. So there should be plenty for people to do, and I think people will kind of reinvent themselves. One of my clients is a Harvard, one of my accounts, I should say, is a Harvard professor, and she had been at one of the major mutual funds. Now she's teaching at Harvard. She told me that in her finance class, she expects that something like 25% of the class may not even look for a job in the traditional way, but may actually start their own companies, not necessarily in technology. So that's, humans adapt. Um, Kevin, hi Ed, if we get past the war in the Middle East, what is your view on gold? Gold seems to be traded like a risk asset in the short term. Do you still like gold at 10K in the long term? Yeah, I think, yeah, I'm still hanging on to the idea that gold's going higher. It's really weird the way it trades. And every time the geopolitical risks look like they're increasing in the Middle East, the price of gold goes down. I mean, it was early on when the war started that the price of gold took a dive, and everybody came to the conclusion it was because Turkey's currency was taking a dive, and that Turkey was using gold to support their currency. But I mean, that just doesn't make sense on the way the gold is trading. So I'm a little bit confused, quite honestly, about what's driving gold in the short run. I think, it had a big move last year and early this year. I think it's kind of consolidating. And maybe there's just some algorithms that are trading this thing, but beyond that, I think there's still going to be demand for gold, and gold will probably go higher. And my thesis is that the stock market's going to go higher, going to go to 10,000, and there'll be a lot of rebalancing demand for other assets, including bonds, including gold. I'll take a couple more, and then we'll ti- uh, let's see. Thank you for having Bridget on. Good info. Thank you. Kevin, okay, last question. I hear professionals like Bridget bring up supply chain disruptions that might be inevitable. If that is the case, am I wrong to expect some type of market correction in the near future? I keep thinking of your quote, I'll worry about higher. Gotta get my screen fixed here. Here it is. Okay, I'll worry about your quote about higher interest rates that I will worry about higher interest rates when the financial markets worry about higher interest rates. Yeah, I mean we've got some really bizarre things going on here. Gold trading down when the war looks like it's escalating. We've got the bond yield just like in a coma here, uh, like nothing special is going on. Um, it may be that there's a Japanese carry trade going on here where there's still carry traders who are borrowing in Japan and buying bonds in the U.S. Of course, that's a bet that their financing rate in Japan isn't going to go up much. And right now, the official central bank rate is 0.75%. So there could be some carry trades going on. Also, the bonds may be acting as they typically do, as a safe haven during geopolitically uncertain times. So we have that. Um, the one thing that's acting the way you would think is the stock market going melting up here because earnings are melting up. So as I said, we've got an earnings-led melt up. Well, that probably means that at some point we're going to have to worry about a meltdown. Isn't that going to be 1999, 2000 all over again? I don't think so. We've had a couple of meltdowns already, particularly in the tech sector, and bounced right back. Again, I don't think this is 1999, 2000, but we'll keep you posted on all that. At any rate, thanks for joining, Bridget. Thank you for joining, and I'm not quite sure what to I'll do next week on Monday. I may make it to for Tuesday. But that's it. And oh, look at that. We've got both Max and Bailey having a good snooze. So that's the story. Thanks, everybody.